Did you know that your bank makes money every single day from the way you use your own account? Not because you're bad with money, not because you're reckless, but because you don't know one simple trick. Every month, small amounts quietly leave your account. Low interest on your savings, high interest on your credit cards, overdraft fees, minimum payments that stretch for years. It doesn't feel dramatic, but it adds up fast. Banks aren't villains. They're businesses, and businesses are built to profit. The less you understand how their system works, the more profitable you become. So here's the real question. Is your bank working for you, or are you working for your bank? Let's break it down. 1. Banks don't make money from saving. They make money from spreading. Most people believe banks exist to protect their money and help it grow. That's partially true, but the real business model of a bank is simple. They make money from the spread. The spread is the difference between what they pay you and what they charge others. If your savings account earns 0.5% interest, but they lend that same money at 12% on credit cards or 7% on loans, they keep the difference. Multiply that across millions of customers, and it becomes billions. This is not illegal. It's not secret. It's simply how the system works. The problem is most people never think about it. They leave their money sitting in low-interest accounts while borrowing at high interest rates. They unknowingly participate in a system where their money works harder for the bank than it does for them. The first trick banks hope you never fully understand is this. They profit from the gap between your returns and your debt. Close that gap, and you flip the advantage. 2. Your savings might be losing money every year. Saving money feels responsible. It feels disciplined. It feels safe. But here's what most people overlook. If inflation is 4% and your savings account earns 1%, you are effectively losing 3% in purchasing power every year. Your account balance may grow slightly, but what that money can buy shrinks. Over time, this silent erosion becomes expensive. $10,000 sitting in a low-interest account for years can lose significant real value. Banks rely on comfort. They rely on customers being satisfied with low returns in exchange for convenience and familiarity. The trick isn't to stop saving. It's important to understand that saving and growing are two different strategies. Emergency funds belong in safe, accessible accounts. But long-term money should not sit idle, earning almost nothing. Idle money benefits the bank far more than it benefits you. 3. Minimum payments are designed to keep you paying. Credit cards are marketed as tools of flexibility, and they are when used strategically. But minimum payments are where banks quietly win. When you only pay the minimum, interest continues compounding on the remaining balance. A $1,000 purchase can turn into $1,500 or even $2,000 over time if carried long enough. The minimum payment is not designed to help you get out of debt quickly. It is designed to keep you in the system longer. Longer repayment equals more interest. More interest equals more profit for the bank. Overdraft fees and small charges are not accidents. Banks understand human behavior better than most people realize. They know people forget due dates. They know people miscalculate balances. They know automatic payments hit at unpredictable times. That's why overdraft fees, late fees, and maintenance fees exist. Individually, these charges may seem small, $30 here, $35 there. But repeat that a few times a year, and you've lost hundreds. Over a decade, that becomes thousands. Banks generate billions annually from fees alone. 5. The real power move. Make interest work for you. Here's the shift that changes everything. Interest is not your enemy. Mismanaged interest is. When you carry debt, interest compounds against you. When you invest, interest compounds for you. The same mathematical force that grows credit card balances can grow investment accounts. But you must decide which side of compounding you're on. Even modest investments, when made consistently over the years, can outgrow the damage of poor financial habits. 6. Passivity is profitable for banks. You don't have to be irresponsible for a bank to profit from you. You just have to be passive. Passive about comparing interest rates. Passive about reviewing account fees. Passive about refinancing loans. Passive about negotiating terms. Banks count on customers staying where they started. They rarely call to offer better rates unless you ask. They rarely reduce fees unless you challenge them. They rarely suggest better options unless you search. The trick is simple. Be proactive. 7. Inflation quietly reduces your buying power. There's another silent factor working in the background: inflation. Even if your bank never charges you a fee and you never carry debt, inflation slowly reduces the value of idle cash. Prices rise. Costs increase. Services become more expensive. If your money is not growing at least at the pace of inflation, you're losing ground. What feels stable today may quietly buy less tomorrow. Banks rarely emphasize this because idle deposits are profitable for them. 8. The system isn't evil, it's structured. It's important to understand something clearly. Banks are not villains. They are structured businesses. Their goal is profitability. Your goal should be financial growth. Those two goals are not automatically aligned. If you do nothing, the structure benefits them. If you educate yourself and act intentionally, the structure can benefit you. That's the shift. The trick is not hidden in secret loopholes. 9. Small adjustments create massive financial differences. You don't need dramatic moves to change your financial direction. Switch to higher yield savings options. Pay off high-interest balances faster. Automate investments. Track fees monthly. Avoid unnecessary penalties. Negotiate rates. Each adjustment may seem minor, but over 5, 10, or 20 years, the difference becomes enormous. Banks understand long-term mathematics extremely well. The question is whether you will start using it for yourself. Because the truth is simple. Money flows toward those who understand how it works, and away from those who don't. Small decisions repeated consistently shape your financial future. The earlier you take control, the more time compounding has to work in your favor instead of against you. Here's the truth. Banks will continue doing what they've always done. They will lend, charge interest, collect fees, and profit from spread. That's their business model. The real difference comes down to you. Once you understand how the system works, you stop being a passive participant and start becoming an active manager of your money. You don't need complicated strategies. You need awareness. Pay off high-interest debt faster. Move idle cash into better-performing accounts. Track your fees. Invest consistently. Small changes made intentionally can save and generate thousands over time. The system rewards those who understand it. It quietly drains those who don't. Now, I want to hear from you. What's the one change you're going to make this week to stop losing money to the system? Drop your answer in the comment box below. And if this opened your eyes, subscribe, because understanding money is the first step to controlling it.